We're Compound Everything. We talk money, markets, and investing. And today we're going to continue on our conversation about cognitive biases. You can head back to last week for the first part, and we're going to cover a few more this week.
Yep. The first one we're going to talk about that was mentioned, is listed in a few papers we saw, was something called overconfidence bias. Mm-hmm. I don't know about you, but I don't really struggle with that one.
No, I struggle with underconfidence.
I would say the same thing oftentimes.
I think I didn't really do much research into that one, but one thing that is kind of agreed upon in the academic world is that overconfidence bias tends to be something that people who are newer to investing or don't have as much experience or education in it tend to struggle with.
Sure.
And so they said, like, the more experienced and the more seasoned investors tend to not, this isn't really a bias for them.
Yeah.
But new investors come in and this really is a difficult thing.
I guess you could say, though, for some of the newer investors or even some, seasoned investors, that overconfidence could be a bit of an issue if you're not keeping track of your portfolio. So for instance, if you're not measuring yourself against the benchmark, you may actually think you're doing better than you actually are. If you were to go back and compare yourself to the S&P 500, you should probably measure your performance against some sort of measure. So, whether it be S&P 500 or, some world index or something like that, and, gauge yourself. And, that would kind of help defeat that bias in a sense. I always think of course, I'm a physician and I do some, teaching of med students and residents and whatnot. And oftentimes you see this bias come in. They come up and they are really gung-ho with this diagnosis that they think they have, and they're completely off base.
Right.
And so I can see how that happens in a lot of things. And you say, well, what about this, and this? And you can watch their ego deflate a little bit as it goes.
And you actually see that in almost any discipline where someone who is very educated in something, they're not as quick to give an answer.
Yes.
I've noticed
because they've been burned.
They've been burned, or they just know, like, okay, there's a lot of this is multifaceted. They're really good at thinking like that, but people who don't tend to have that an education in a particular realm tend to seem to know everything about it, and their answer is always right? Yeah. And I guess you see that on social. Like, people go from being like macroeconomic experts to vaccine experts to who knows what other kind of expert they are.
That's right.
Yeah, I would say that overconfidence bias really affects, and I don't know who said this, but they said the worst thing that can happen to an investor is that they do really well in their first year.
Yeah.
And I would think that overconfidence bias would really affect someone who came into the market and did really well, not so much because they were so smart or they were good at picking stocks, but they just happened to come in at the right time.
A rising tide effect.
Yeah, so that's one that I guess some people obviously do struggle with, but definitely not me. So the next one we're going to move on to is regret aversion. And this is not something I have actually heard of before. I've heard of a lot of common ones.
But I struggle with it.
Yeah, okay, except that you do it.
I know I do it.
And so it actually helped me identify something that I actually really do. I really am affected by regret aversion. So regret aversion is not doing something because you're avoiding regret, even though that something could have a big positive impact in for you. So for instance, you and I, we look at a lot of businesses to buy. We're always looking at buying businesses, buying stocks, whatever. We want to buy cash flowing assets. And a lot of times what causes us not to pull the trigger, even if all the financials are there in a particular business, we looked into one recently, it cash flows, it does well, it's not hard to understand.
Nope, not at all.
But what keeps us from purchasing it is that we don't want to regret buying it.
Yes.
But it would probably be a decent purchase. So we're avoiding regret.
Yes.
We're avoiding future regret. And I struggle with that one so much. I will not do a good investment because I'm so afraid of regretting it later.
I think one of the ways to look at this is the articles that we've read say this may cause an investor to take less risk than is actually appropriate.
Yeah.
And so you it's almost like that hide your money under the mattress kind of a scenario because, well, at least it's safe there. And it's maybe avoidance of status quo in a sense, So I wonder if that's maybe part of it. And really, in a sense, I might actually include FOMO, or fear of missing out, under this one to a point, although maybe you could categorize that on its own. And that is just maintaining the status quo in a position, even though you've either maybe taken a loss or you maybe know it's not the best position, but you are afraid of selling it.
You're afraid of regret.
You're afraid of regret. Well, if I sell this position, I might regret it if it quintuples in value.
The funny thing about regret aversion is kind of a dichotomy because you're not doing something because you're afraid of risk. or you're afraid of loss, sorry. And you said like you don't want to take the risk, even if the risk is small. So with the regret aversion, the bias often comes in an asymmetrical position where the risk is less than the potential gain, right? And you don't take the risk because you're afraid of the regret. But the dichotomy is then you don't take it. And 10 years later, you're like, oh, I should have bought that house. I should have bought that business. You regret
it later. It's delayed regret.
So you still have regret. So you're avoiding this one regret in case the investment goes wrong.
Yeah.
But because in this case, it's often considered like asymmetrical, it often isn't wrong. And then you actually end up having even more regret anyway.
Yeah. It's the interesting thing about regret aversion. I've struggled with that as well. Yeah. It's often just easier to maintain status quo than it is to actually put yourself out there and take a risk. Is a terrible emotion. It is a terrible emotion.
Like regret is one of those emotions that really hurts to have. Yeah.
Well, and circling back a little bit to your prior example of buying a business, if you think of, and I think we've talked a little bit about this in prior videos when we broke down Jeff Bezos' letters, he talks about certain decisions that you can make. Some are reversible and some are irreversible. So let's say, for instance, we decide to take on a small business. We buy a small business. Well, we buy a small business, and let's say we don't like it, we can sell it.
Yeah, it's not like
you can. It's not permanent. There are some decisions that you make that are permanent. You know, having a baby is a pretty permanent decision. Getting married is a pretty permanent decision. A good one, by the way. But buying a business, buying a home, buying a rental property, and so those things are not necessarily irreversible decisions. I mean, they may be a little bit more difficult to escape at some point in the future. It might entail some costs and things like that, but it's not completely irreversible.
Right. Since we're talking about psychological issues with humanity, it's interesting that you say that, and I don't know what bias this would fall under, but for some reason humans are really prone in thinking in absolutes, which is funny because we all know the saying from Star Wars, only Sith thinks in absolutes, but humans tend to also think in absolutes. And like an example from my own life going back 15 years ago was when we decided to homeschool our children for a while. And what was making that decision so hard for me to make, because I was agonizing over it, was I was thinking like, whatever I choose now, if I send them to private, if I send them to public, this is back when they were in kindergarten, if I homeschool, like I was thinking in permanence. So I better make the right decision because this is the next 12 years of their education. And an older woman said to me, she was like, whatever you decide, you could change your mind the next day and do the other. And that made that decision so much easier. And then we said, okay, we'll homeschool this year and we'll see how it goes. And one of our kids actually was homeschooled for up to grade 2 and then said, I want to go to school. And she went to school and 3 weeks later she said, nope, I want to be homeschooled. So she came back home.
It was an easy thing.
Yeah, but not thinking, like, you're right, there are some things that are permanent. But most of life is not permanent.
Well, I mean, if you think of one way to combat this potential source of bias, would be to think, is this decision permanent or is it not permanent? Is it reversible or not reversible?
Right.
And if it's not reversible, how hard is it to reverse that decision? Yes. So for instance, I buy a stock and
very easy to reverse.
I decide I don't like the position. Well, sell it.
Yeah.
A lot of the best investors will do that. I've heard of investors like George Soros who will take a position and the next day, take the complete opposite position and completely counter that.
Ackman too. Ackman is really good at being like, you know what? We didn't like that decision.
Exactly.
Or it changed. Something's different.
I mean, it gets a little bit more difficult, and again, when you're dealing with real estate and stuff like that, but it's not permanent.
Maybe you'll take a loss.
Yes.
But that is, you're not going to have 100% win rate.
Right. No, and of course not. So I think you could lump this kind of bias in, and maybe I'm going a little off the rails here. You can look at it as taking less risk than you should, which often, as you're alluding to, is maybe not such a risk. Okay, so maybe we overestimate the risk in certain circumstances, but in certain circumstances as well, it could cause you to take more risk when you're talking about FOMO or fear of missing out. And I'm lumping that in there a little bit because I really struggle with that one. I'm going to be honest.
We're kind of all over the map here, but it was just the permanence part really struck me because I'm like, that affects a lot of my decisions is thinking in permanence.
Yes.
And it's like, why do I do that? But so many people do that.
Oh, very much so. It's very black and white thinking.
Yeah.
Whereas most of the world is gray.
Right. Yeah.
So okay, I think that's good for that one.
So I actually really love studying regret aversion because it's something that helped me identify something that I struggle with that I didn't even know really existed. And it made sense to me that I didn't want to regret things and I was not being aggressive enough when I should be. So that was a super fun study for me.
Yeah.
Learning a new bias that I have.
Yeah. When I think if you can name it and realize that you do it, you can combat it.
Yeah, or at least try.
Right. Just like you had mentioned with the homeschooling. So if you're made aware of it and someone points it out and says, that's not permanent, right?
Right.
Oh yeah, no, it's not.
Yeah.
So the risk isn't there that I thought it was.
Right. So that was a really great one. So why don't we move on to the next one?
Sure. The next one is loss aversion. Mm-hmm. So loss aversion, I mean, no one wants to lose anything, but in the markets, it's a reality. You're never going to bat 100%, right? So you're gonna find some losses. But loss aversion is a potential bias where people tend to look at the short-term fluctuations in the market more so and have a disproportionate impact on them, maybe emotionally, than the potential longer-term upside. Right. So for instance, if you look at an investment like Apple, for instance, if you had bought it in 2016, then it would have been fairly lumpy. You might have been up and down and up and down and up and down. But over time, that investment has worked out very well for a lot of people, like fivefold. So the loss aversion tends to weight people's perceptions more towards the short-term fluctuations in the market, again, rather than the potential or in many respects, maybe even probable long-term payoffs.
If the company is really great.
Well, you can even look at the SPY, for instance. So we know the SPY over the long run has averaged 10% compound annual returns. But if you were to invest in the SPY today and tomorrow it drops 5%, you'd be feeling pretty lousy about yourself, right? And you might overweight that, saying, oh, shoot, I should have waited until, tomorrow. But 10 years from now, is it going to matter whether you put your $500 in the SPY index today versus tomorrow versus on next Thursday? No, it wouldn't make it look a difference.
Right. And that's why you have people say, if you had bought a share of Amazon in this year and you held it till today, you'd have X amount of dollars. And then the comments are always like, oh, but no one would have done that. And the truth is, very few people would have done that. And the reason is because, I mean, there's several reasons, but one reason is loss aversion.
Yeah.
Because like you said, especially companies that are growing still, right? They go up and up and up, and then they might have a terrible drop, right? And then at that point, you might be thinking like, oh, I don't want to go through that again. So when it goes back up, you sell because you've already felt that loss, right? And you don't hold it for 20 years. You don't hold it for 30 years. And that's the way that I think that an investor can combat loss aversion is by digging down into the fundamentals.
I was just going to say that exact same thing.
Yeah. I think that's the cure for loss aversion. And I guess the modern term for loss aversion is paper handing.
It would be paper hands. Yes, that's right. Yeah. That's right. So that's loss aversion in a nutshell. Yeah. I don't know if you have anything else to...
No, I think that's it. And I think loss aversion probably affects all of us without us really realizing it. But it is true. Like, I think loss aversion really affects traders more than long-term investors.
I buy that. The other thing, and I don't know, maybe you can't lump this into loss aversion. Maybe there's a better category for it. But one thing I've struggled with in terms of loss aversion is realizing capital losses.
Yes.
So, and you've told me that before. Why don't you just sell it?
And, like, if you wouldn't buy this company today, why are you still holding it?
Right, because at that point it makes that loss a reality. Yeah. I have to own that loss.
Yeah, it's not paper anymore.
It's not paper anymore. It is a realized loss now.
Yeah.
I've realized that loss. Even though, funny enough, we've looked at positions where we thought, oh, we should sell XYZ position, which is down, a significant percentage point, and invest into this. Meanwhile, if we had done that, thinking rationally and not being affected by loss aversion bias, if we had done that,
because it's like, what if it goes back up?
Or FOMO, we would be way ahead, even more so than our loss.
Yeah.
And we've dissected that on numerous occasions.
Yeah.
So oftentimes, I think you're right. Going back to the fundamentals is helpful. So are the fundamentals of the business change? If they are, get out, realize the loss. If they're the same, well, you have to decide: are you going to hold it or buy more, or what are you going to do? And then thirdly, don't be afraid to take a loss in that sense if the fundamentals have changed. Don't recognize this loss aversion and just own it.
One thing that kind of shows loss aversion is more short-term thinking is to compare real estate to stocks.
Yes, right.
Right? Because if you go through, interest rates go up and housing costs come down, I don't really see any real estate people really freaking out here because
not so much.
People who buy real estate are in it for the long haul. I actually think that that's one reason why so many real estate investors do better than stock market investors is because, like, I'm talking like dumb money here.
Yeah.
Is because the real estate guys are kind of more locked in.
Yeah.
It's not permanent, but it is more permanent than a stock.
Right.
They don't have tickers flashing up on their
Sure.
screen and all this stuff. But they know when the market turns, they're like, okay, well, it's going to go back up.
Yeah.
Whereas stockholders and people in the market, it's very different because it moves so quickly.
Yes. Oh, absolutely.
So I think
there's tickers flashing at you constantly, and you can get it in and out in the click of a button.
Yeah.
No problem.
So I think like the real estate comparison really shows like, loss aversion is really affected by that short-term mentality.
Oh, absolutely. I think there's very little question of that.
But the illiquidness of the real estate market really works to it works to almost control your biases for you.
Yeah. It makes you more rational because oftentimes biases are found to be from emotion.
Mm-hmm.
Okay, well, and there's the cognitive part and then there's the emotional part. I find, unfortunately for myself, I'm often driven more by emotion than anything else, especially in the moment. So from that standpoint, I think it works to defeat that because everything just slows down. It's a slower game, you know.
Yeah, and you don't have someone knocking on your door every 5 minutes being like, oh, your house is worth this now. Oh, your house is
that would
worth
be nauseating.
that now, yeah. And, you know, we can see that in our own portfolio because probably one of our best investments is, in fact, our farmland.
Yeah, absolutely. Yeah.
So moving on, let's talk about mental accounting, and I'll let you explain that.
So mental accounting is essentially having different baskets for things. So mental accounting actually oftentimes can be used as a useful tool.
Yeah, I use it all the time.
In my opinion, anyways. So mental accounting might be that you've got one bank account for expenses and one bank account for savings. And you don't lump them all together.
You never ever go into the savings.
And you never ever go into the savings. That's at its most simple. That's a way to do it. So, or for instance, if you're going to the racetrack and you go with $20, your winnings go in your left pocket and the money you started with goes in the right pocket. You don't touch whatever's in the left pocket, right? So the racetrack is one example. The other example might be if someone's in the stock market, then they might view the initial investment as their money and any gains as kind of house money. So once they sell a position that's gone up, let's say 100%, so they did really well in this investment, they might look at that additional capital as being just house money and may actually be a little bit more reckless with it. So that's where mental accounting may actually get you into trouble.
House money.
It's house money, and so they might be more inclined to gamble with it or take a little bit more risk than they should. Right. And in that respect, that's not a good form of bias in that way because money's money. Yeah. Right? So it doesn't matter where it came from.
Yeah, and that's in the book Misbehaving by Richard Taylor, which is a really good read and highly recommended. He talks about like if we were like true, like if we only thought in things like in what's best economically for me. Every decision I make is like going to work in my favor economically, but he's like, we don't think like that.
Yes.
Because we're human.
Yes.
Right? And so an example of that is if we were these economic humans, we would never treat house money as gambling money.
Right.
Because we are trying to build wealth. We're trying to compound at the highest rate possible. And we would never do that, but we're human.
That's right.
So we don't do that.
Yeah.
And like sunk cost fallacy is another one, right?
Mm-hmm.
Like you buy a ticket to a concert and you're super excited and it costs $80. And then the concert day comes and it's blizzard and it's like you're really disappointed because you can't go, so you're like, no, I'm going, and you drive reckless. You take a risk, you go out, you drive recklessly just to go to this concert because you're like, I wasted $80. But whether you went to that concert or not, the $80 is a sunk cost.
It was still gone.
Now the problem with that is, and he said it happened to him, and now we're finding it's happened to us, is that we talk about these biases. And one day my daughter couldn't go to something, and I was like, oh, but we paid for it. And then she's like, sunk cost fallacy. So it does come back to
that's true.
To bite you. But back to the mental accounting, we do mental accounting because we're not economically driven. Mm-hmm. We are in fact human, and sometimes that helps us to be more economically sound, and sometimes it actually works
in our disadvantage.
Yeah.
So it's an interesting prospect. So I think you can use it in a good way in a sense. So for instance, savings and whatnot, maybe a good way to use this whole mental accounting model. Maybe you're saving for a trip.
To a point. I've heard of people taking out loans because they don't want to go into their savings account for things, right?
And
so that would be like, that's where it's a bias.
Sure.
Because it's
a
like,
misjudgment.
And a misjudgment, because it's like, okay, wait, you have the money in an account to do whatever, but you're going to take out a loan and pay interest on that? That's bananas.
Yeah. So it really depends on how you use it. So you might use different accounts, and you're still doing this mental accounting gymnastics, I guess, in a sense. So it can either work to your advantage if you use it properly, or to your disadvantage, which is probably going to be a good portion of the time as well.
Yeah, I am going to go back to what I said. If you can borrow money and and make money on it, and make more money than what your interest payments are, then that's like the one exception.
That makes total sense.
Yeah.
Yes.
So that's a different scenario.
That's a completely different scenario.
Okay, so next is herding effect, and I don't think that there's a single human on the face of the earth now or in the future or in the past that is not affected by herding.
One recent example of that was GameStop.
Even today.
Right? Even today. It literally happened today.
Yeah.
So people have a tendency to want to follow a herd. And another funny example of that, actually, we were in Disney World a little while ago.
Yeah, about a decade ago.
Maybe more than a while ago. And we went and we saw a line, and we just joined the line, and we assumed it was the line to get in, when in actual fact it was a line to nothing.
To nothing.
There was literally, we were standing in line, thought, I think we were going to get into Disney World, and it was a line to literally nothing.
Yeah.
So we literally joined the herd. So we stood there for about 5 minutes and realized the line wasn't going anywhere, and then we decided, let's go check where this is going, and funny enough, it went absolutely nowhere.
Well, and you see that too, even back to Disney World, when you get off a ride, there's a few times everyone was going out of the one exit, and then you'd be like, well, let's just go with that exit, because no one was going. But that is exactly herding effect, because it's a herd of people.
Yeah, and that is a source of cognitive bias. Mm-hmm. So everyone's doing something, therefore it must be something that's good to do.
Right. Or it's not even good to do. Maybe you know it's not good to do, but it's like, I'm not going to look stupid.
Sure, there's that part of things, but I mean, it's also a survival mechanism, right? So if everyone is avoiding eating, red and white mushrooms, and you decide, I'm going to go against the grain and eat red and white mushrooms, you might find yourself dead.
Right.
So at that point, it's probably a good idea to follow the crowd many of the times. Right. But having said that, I
have found in my life that the majority of the time, it's not good to follow the crowd.
Sure. No, and I agree with that.
I can't actually think of a time in my life where following the crowd would have been better for me. Okay,
fair enough. Yeah. I can understand that.
Yeah. I mean, maybe if I lived in an era where information wasn't as available, so I didn't know what to eat or what not, maybe. But now in modern society, I really can't think of a time where I went against the crowd and it turned out worse. Almost every time I go against the crowd, it's almost always better.
Well, and here's just an adage would be that, and a truism would be that if you want to get results that are better than average, you can't follow the crowd.
Right, you can't, because you would be average.
Because you're average by definition if you're constantly following the crowd.
And that's why people would say, well, why don't you just put your money in a broad market index? And that's a good point, because here's the thing. You're going to make money. You're going to compound it. But the thing is, I don't want average returns. I want above average returns. And broad market will always give you average returns. Yeah. Those returns aren't bad.
Right.
But like Monish Pabrai says, I want to beat the game.
Sure.
Yeah.
And another example maybe of herding that you could use to your advantage on a smaller scale is the idea of cloning.
Right.
So we have spoken about cloning before. We like the idea of cloning, generally speaking. So in a sense, you're following a bit of a mini herd there. So if you see a bunch of value investors who are, maybe piling into a certain stock, and you look into that stock and you deem it attractive, then you can use herding in a sense with the right people as a source of ideas.
Right.
Now, granted, a lot of these value investors are probably contrarian by
I was going to say, that's
their
not
own
really
right.
herding, though, because herding, according to Lilu, only 5% of investors are value. So if you're copycatting value, you are by definition not herding.
Sure, and I use the term loosely.
Okay,
I'll lump.
I'm being devil's advocate here with you on this one.
That's okay. I'll lump cloning in there very loosely.
Okay, yeah.
Maybe it's just more of a tool I like to use.
Because herding effect would be like the vast majority.
Sure.
And so the example is that study where they were showing those lines to a group of educated people and saying and one person wasn't in on it and the rest of the control was in on it, and they all had to pick the answer that was obviously wrong.
Yeah. Right?
And the majority of people ended up saying that answer, even though you knew beyond a shadow of a doubt, they knew that was the wrong answer, but start second guessing yourself, right?
Yes.
There's two things that happen. So maybe if you're a money manager, it's better to be wrong with the crowd.
Sure.
Right? So that's one way. And then the other way is you start thinking am I the only, am I wrong here? Mm-hmm. How can I be right when everyone else...
well, I think that's the basis of herding effect.
Yeah.
Right? So the basis of the herding effect is if you're going to go out on your own, you're seeking your own best interest.
Yeah.
But if the herd is doing one thing and you're doing another, you better be darn sure that what you're doing is in your own best interest.
Yeah, and here's the thing. The herd can sometimes, too, really put you through it if you do something different.
Oh, very much so.
The herd also doesn't like when someone else...
Deviates,
because that makes them wonder.
Sure.
So the herd doesn't like it either. So if you're going to take a position that's counter, you better be ready to take the heat.
Well, and you've noticed that. I mean, if we've posted some of our positions on social media and whatnot, specifically thinking of Meta back a while back. We used oil position. Actually, oil is a very good one. We took oil positions back in 2020, and everyone was telling us, well, electrification is going to be a thing, and oil's going, we're getting away from oil and whatnot. And those have been and still are some of our best investments. So we took a fair amount of social flack for investing in...
I got raked over the coals for oil. Really, people were mean.
Yes, exactly. Both of us did. And so from that standpoint, if you're going to be somewhat public with your position, you may find that the herd decides to bite you a little bit about it.
Yeah. Now, the issue on being public, going back to another bias, is as soon as you're public, you have to remember that you have to be willing to change your mind.
Oh, absolutely.
Because again, we're not driven only by economics. We're human. So you have to be able to change your mind if that position changes, and now you have to publicly come out and say I was wrong.
Oh, it's humiliating.
And so that's the one thing. Sometimes when I post publicly, I'm like, am I going to be able to change my mind on this now that I've thrown it out there?
Yeah, markets are made up of people.
Yes, they are.
Right? Markets
That's
are
all they are. They're all people.
And we talked about how Ben Graham talks about Mr. Market. There's an analogy of Mr. Market and how he's kind of like a manic depressive. And most of the time he's fine and he's even keel, but sometimes he gets, wildly manic and he'll offer you an insane price for your shares. And other times he gets so depressed he'll show you his shares for a song. But the point being is that markets are made up of people. And so at the end of the day, this is people. I like the analogy, but what it does do is it depersonalizes Mr. Market. Mr. Market is just a group of people who are all acting in concert. In a sense, they're acting like a herd. And sometimes the herd gets it wrong on the upside, and sometimes the herd gets it wrong on the downside. And so what we want to do as investors is when they're getting it wrong, we don't want to join them. And so better yet, we want to capitalize off of them.
Oh, for sure. And you said that to me yesterday. You're like, something always bothered me about the Mr. Market analogy.
And that was it. It was the depersonalization.
Yeah, it wasn't the politically incorrectness. It was the fact
Maybe it should have been.
You were like, yeah, something always bothered me. And you're like, and then I realized it's because it doesn't personalize it. And the whole point of that analogy is to say, hey, there's market psychology.
Yeah.
But when you depersonalize it, you forget, wait, I can use this to my advantage.
Yes, exactly.
I can use it.
Yeah, and I don't want to be one of the ones acting irrationally.
Right.
So you can reflect it back into yourself and say, okay, I don't want to be one of these irrational actors. 100%. People are acting irrationally. I don't want to join them.
Right. So lastly, we're going to talk about optimism bias. And that just means that people think of the future in a more optimistic way, which of course we all know as investors that would definitely alter our investing strategy. And you can see that with quotes like stocks always go up.
Yes.
Right. And we know,
Thank you, Dave Portnoy.
Yes. So you can see that. And that's back to herding. Like everyone says, stocks always go up, and it's un-American to sell a stock, and it's un-American to short because stocks always go up. And you can see that. And that's just an over optimistic view of the future, because we know that in fact, sometimes stocks do go down.
Sure. And one of the ways that you can maybe counter this is twofold. This is where Charlie Munger would say, invert, always invert. Mm-hmm. So whenever you have an investing thesis, think about how is this going to burn me, potentially. Yeah. The other thing is sometimes the psychology literature talks about doing something called a pre-mortem. Mm-hmm. So we know what a post-mortem is. So a post-mortem is where you figure out, how someone died, or, how a bad event happened. But they advocate actually doing a pre-mortem and trying to kind of suss through how are all the ways that this potential investment could burn me before you take on the investment. So it kind of knocks down your optimism a little bit to a reality, does a reality check.
Yeah, we need to be each other's no. Okay, let's look. We need to be the devil's advocate and be like, what about this? Have you thought about this?
I think, though, we're not bad at that. I think what we do, we say, yeah, that's a good idea, but what would you do in this scenario? Yeah, we are encouraging, yet at the same time, we try to provide each other reality
I think we could be better at it. But we also don't want to be rude or mean, right?
No, because we love each other.
We love each other. So another thing about this, and I was reading about this one, and I thought, okay, yeah, people are optimistic about the future, and that's not bad, because people who are
constant pessimists, it's sad.
They're a drain to be around, right? For sure. So I don't think this is a bad thing, being optimistic about the future. But one thing that came into my mind was Howard Marks was in an interview that I listened to, and one of the reasons he said he did really well in 2008 is because they ended up backing the truck up and buying a lot of stuff, and the interviewer said, why did you do that? How did you come to confidence with that? And he said, well, I started thinking, if everything happens that everyone believes is going to happen right now, is it really going to get that bad?
Mm-hmm.
Because if it gets that bad,
we're all done for.
We're all done for. And he was like, I don't think it's going to get that bad.
You're right.
So then I guess I was like, okay, there's an optimistic bias, but could there also be a negative bias?
Oh, yeah, absolutely.
So
yeah, I totally agree with you. So I think one of the ways to maybe combat this source of bias is, just as you mentioned, have an abominable no man or no woman. Have someone to bounce your ideas off of. And I think that's where we help each other out a lot, because we do bounce everything off each other.
And if you really want a negative, if you really, really want your thesis torn apart, write a due diligence and put it on X. Or put it up somewhere.
Because let
me tell you, people who disagree with you,
they
will rip your thesis apart.
Yeah.
But sometimes they do. Once in a while, you'll have someone who genuinely is educated in what you're talking about, and will point things out to you. You're like, oh yeah, I never thought about that.
Yeah. So, I mean, I'd say that loosely, but because I've made some good investing decisions where everyone ripped me apart, and they've turned out very well.
You have to make sure they know what they're talking about.
You have to make sure
usually a lot of people just are giving their opinion. Yeah. Everyone's an expert.
Of course.
Yeah.
But I think you and I do a fairly good job of that. You'll often ask me, you'll say, well, what about this? Or what about that? And, are you sure that you want to make that investment? And I've done the same to you.
Oh, you
have. And we kind of hold each other accountable.
So why don't we wrap it up there?
Sure.
If you can like and subscribe, that would be great. And we'll see you next week.
Good.